Imagine checking your balance on a quiet morning. Same routine, same digits, nothing unusual. But somewhere, in a building you've never seen, on a screen you'll never touch, someone is watching that number too, and not just yours. For decades, privacy was built into the system, especially for those who knew how to ask for it. Hidden wealth flowed through marble halls and offshore vaults, unseen, untouched. But that era is ending. It didn't collapse with a bang. It faded, law by law, signature by signature. Governments sharing data, banks breaking silence, secrecy becoming liability. The same protections once reserved for the elite are dissolving for everyone. Because now, it's not just billionaires being tracked, it's you. And your money is no longer invisible. But to understand how we got here, we have to revisit the golden age of secrets. When hiding wealth wasn't suspicious, it was smart. Before the system turned against secrecy, secrecy was the system. For much of the 20th century, global banking had a sacred rule: don't ask, don't tell. Not just in shady corners of the world, but in polished offices in Geneva, in private suites in the Cayman Islands, in discreet buildings across Luxembourg. This wasn't just about hiding money from governments. It was about protecting it from politics, from instability, even from family disputes. The Swiss built an empire on this code: numbered accounts, untraceable transfers, a legal framework so strong, even prosecutors struggled to pierce it. In 1934, Switzerland passed the Banking Law of Secrecy, criminalizing the disclosure of client information. Not a fine, not a warning, jail time. It worked. For decades, it worked. If you had wealth, real wealth, you didn't keep it where you lived. You sent it somewhere quieter. Offshore became a password, a lifestyle, a way of thinking, and the world didn't just accept it, it encouraged it. Governments looked the other way, banks expanded offshore arms, consultants built careers teaching the elite how to vanish on paper. By 2007, Swiss banks alone held over $2.7 trillion in foreign assets, much of it owned by clients whose governments had no idea. The Caymans weren't far behind, a territory with more registered companies than people. One building, the infamous Ugland House, listed as the home of over 18,000 businesses. How? Simple. Shell companies, complex trusts, anonymous foundations, all wrapped in a culture of plausible deniability. You could own everything without your name appearing anywhere. This was the golden age of financial invisibility, and it didn't feel illegal. It felt sophisticated, strategic, quietly powerful. But in the shadows of this perfectly oiled machine, something else was forming. Whispers inside the US Treasury, meetings in Brussels, leaks too precise to be accidents. It was the beginning of a new doctrine, not to fight crime, but to end secrecy itself. And the first real strike? It came from the one place no one expected. The first strike didn't come from hackers or whistleblowers. It came from Washington. In 2010, buried inside a U.S. domestic jobs bill was a quiet provision called FATCA, the Foreign Account Tax Compliance Act. Few noticed it at first. Just a few pages, just a few requirements. But those few pages rewrote global banking forever. FATCA forced every financial institution in the world, from Zurich to Singapore, to report American clients directly to the IRS, not just upon request, automatically. If a bank refused, the U.S. would hit them with 30% withholding on all transactions involving American assets. It was brutal, and it worked. Major Swiss banks, once temples of silence, began disclosing names, Clients were exposed. Accounts were frozen. Billions quietly returned to U.S. tax authorities. But that was just Act 1. The rest of the world saw what the U.S. had done and followed. In 2014, the OECD, a coalition of developed nations, launched the CRS, Common Reporting Standard. Same principle, different name. Over 100 countries signed on. Automatic data exchange, cross-border transparency, no more hiding behind borders or banking codes. Now, when someone opens an account in London, the information could be sent to Berlin or Rome or even Bogota. Silently, instantly. The era of plausible deniability was ending, not with a crash, but with a sink. Bank secrecy was no longer a national policy, it was a global liability. Even the icons began to fall. In 2008, UBS, Switzerland's largest bank, was caught helping U.S. citizens evade taxes. The fallout? A $780 million fine and the surrender of 4,450 client names. Then came Credit Suisse in 2014. Another giant, another scandal. This time over $2.6 billion in penalties for aiding tax evasion. By 2015, the unthinkable happened. The Swiss parliament, under international pressure, agreed to dismantle its legendary secrecy laws, the same laws that built the modern wealth management industry. It wasn't just Switzerland. Liechtenstein, Austria, Luxembourg, Jersey, Guernsey, all began adjusting, softening, complying. One by one, the doors closed, not with violence, but with signatures. And while the public headlines focused on tax evasion, insiders knew the truth. This was not a war on crime. It was a war on opacity. Because opacity wasn't just used by criminals. It was used by families, dynasties, companies, even charities to move, protect, and grow wealth without exposure. Now, that layer of fog was being lifted, and something darker was emerging beneath it. Because when secrecy dies, what replaces it isn't always fairness. Sometimes it's control. But before we see who paid the highest price, we need to look at what happens when the veil gets torn off and names finally come out. When the veil was lifted, it didn't just reveal money. It revealed names. In 2016, a leak from a modest law firm in Panama set off a global chain reaction. The Panama Papers. 11.5 million files, 214,000 offshore entities, presidents, celebrities, royal families, Fortune 500 CEOs. Suddenly, the private became public. Trusts once buried in Caribbean shells were headline material. Hidden real estate, undeclared art collections, quiet ownership of entire industries. No alarms. No escape. Investigations launched in over 80 countries. Assets were frozen. Lawyers disappeared. Politicians resigned. Then came the Paradise Papers. Then the Pandora Papers. Each leak more surgical than the last. Each exposing a different flavor of secrecy. Shell games in Singapore. Blind trusts in New Zealand. Corporate pass-throughs in Delaware. But the real shock wasn't just the volume. It was the vulnerability. Because even billionaires, with armies of advisors and decades of planning, weren't safe. Accounts were frozen retroactively. Wealth planners were subpoenaed. Heirs found themselves locked out of family fortunes they thought were secure. Some structures collapsed entirely. Trusts that once protected assets from generations of political shifts were dismantled by a single treaty. Private foundations, carefully constructed over years, were reclassified as taxable entities overnight. There are stories that never made the headlines. A Saudi tycoon in London whose entire offshore web unraveled after a single transfer triggered a compliance audit. A Russian magnate whose children lost access to a $300 million fund after CRS data was shared across 4 jurisdictions in under 48 hours. A Latin American industrialist whose foundation was unmasked by a formatting error in a tax file. Small cracks, massive consequences. And for every exposed billionaire, there were hundreds more, watching quietly, moving quietly, restructuring faster than regulators could blink. Because in the post-secrecy world, survival isn't about how much you have. It's about how fast you adapt. But where do you run when every country starts looking the same? The answer isn't where you think. Because while the old safe havens were crumbling, new ones were quietly rising. As the old world of secrecy collapsed, a question echoed in boardrooms, family offices, and private jet terminals. Where do we go now? The answer wasn't found in the past, but in reinvention. The truly wealthy didn't panic, they pivoted. Because invisibility never really dies, it just changes address. And the first new address was Dubai. No extradition treaties, no income tax, and most importantly, no automatic data exchange under CRS. Dubai positioned itself not as a tax haven, but as a financial innovation hub. English-speaking courts, modern infrastructure, and a deep respect for discretion. Family offices opened in clusters. Real estate became a vault. Citizenship programs offered second or third flags to shield identity. But it didn't stop there. Enter the age of crypto offshore. While headlines focused on Bitcoin prices, insiders focused on structure. Private wallets, cold storage, layered entities in Estonia, Georgia, the Bahamas. Digital assets held in DAOs or decentralized autonomous organizations, legally distinct, technically global, and politically untouchable. Some billionaires went deeper. They used dual entities, a foundation in Liechtenstein owning a trust in the Cook Islands, which held crypto keys stored in Swiss bunkers with access granted via biometric verification in Singapore. It sounds like a thriller. It's not. It's compliance. But legal didn't mean visible. Because each layer was wrapped in purpose-built regulation, local compliance, and just enough opacity to pass scrutiny while staying out of reach. Others took a more traditional path, but restructured everything. Instead of personal accounts, they used private investment vehicles, feeder funds, holding companies, special purpose entities. Not to hide money, but to fragment it. A billionaire's portfolio today might touch 12 jurisdictions, 8 time zones, and 6 legal systems, none of which alone reveal the full picture. And the names? Rarely theirs. The rise of proxy control meant that a personal assistant, cousin, or minor shareholder could be the public face of a billion-dollar entity with no real authority. Then came Eastern Europe. Places like Georgia, Armenia, and Serbia began offering residency to foreign investors, with banking systems that technically complied with CRS but lacked enforcement mechanisms. A quiet loophole for those who moved fast. Some jurisdictions even offered non-dom regimes, allowing foreigners to live, invest, and bank locally without triggering global reporting. And just like that, a new map emerged. Not of tax havens, but of information havens. Places where privacy wasn't promised, but where systems were too immature, too fragmented, or too politicized to enforce full transparency. The new game wasn't about hiding from governments. It was about staying one step ahead of their technology.
Because in a world of automatic exchange, algorithms decide what gets flagged, and those who control the structure control what the algorithm sees. But this arms race between wealth and regulation didn't just leave governments behind. It left something else behind, too. The average person. Because while the ultra-wealthy upgraded their defenses, the rest of the world was still using the old playbook, and the walls were closing in.
It's easy to think this story was never about you. That banking secrecy, offshore trusts, and information havens are problems for someone else, someone richer, louder, more exposed. But that's the trick. Because while the elite raced to rewire their protection systems, the rest of us were left inside a vault that no longer locks. Today, even a basic bank account triggers alerts. A wire transfer between countries? Flagged. A second citizenship? Reported. A new investment vehicle? Logged and stored. Not because you're a suspect, because the system suspects everyone. Governments are no longer asking for permission. They're collecting by default. Under FATCA and CRS, your financial information might already be shared across borders, without your knowledge, without your signature. It's not just about hiding wealth. It's about mapping behavior. Where you spend, how often, on what, with whom. The goal isn't just taxes, it's visibility. And once you're visible, you're manageable. What used to require a court order now takes an API. And the banks? They didn't fight back. They integrated. KYC, AML, AI-driven transaction monitoring, facial verification, pattern analysis, suspicious activity reports, flagging thresholds, and soon, central bank digital currencies, programmable, traceable, enforceable by design. This isn't speculation, it's happening. In Europe, in Asia, in the Americas. Financial privacy isn't just fading, it's being redefined. And here's the part no one says out loud. The people with the most to lose have already adapted. They've moved assets. They've structured differently. They've changed jurisdictions. But the average person still believes the system is neutral, still assumes the rules are fair, still thinks compliance means safety. It doesn't, because this shift wasn't designed to protect you. It was designed to reveal you. And once revealed, there's no going back. But before we close, there's one last thing you should see. Because this story doesn't end with surveillance. It ends with a question.
Imagine a satellite orbiting silently above the Earth. It doesn't blink, it doesn't sleep. It just records every movement, every signal, every transaction that pulses through a system we no longer understand, but depend on completely. Now imagine that lens not watching the world, but watching you. Not for safety, not for crime, just because it can. Your accounts, your credit, your patterns, what you buy, when, with whom, not tracked because you're a threat, but because you're part of the equation. This is the future of finance, not encrypted, but exposed. And the most dangerous part? It feels normal. You still log in, you still spend, you still believe the vault is locked, but it's not. The protections that once came with wealth, power, or distance no longer apply. The system doesn't discriminate, it integrates. And every update, every innovation, every security measure brings you closer to a world where financial autonomy becomes optional. A future where money isn't just seen, it's governed. Where permission replaces ownership. Where the safest place for your wealth no longer exists. And while the world debates convenience versus control, a quieter truth emerges. This isn't about hiding. It's about choosing what remains yours. Because when privacy vanishes, it's not just numbers at risk. It's your last layer of freedom. So ask yourself, if everything is visible, what's still untouchable? And if the vault is open, what's your next move?